Hi, this is Rakesh. Welcome to our new accounting video. In this video, we are going to see what journal entry the firm will pass when a new partner is not able to bring his share of goodwill in the firm. Right? So here I have taken one question, and through this question we will see that journal entry. Right? So let's go through the question first. Here we have a question, and the question says that A and B are partners in a firm sharing profits and losses in the ratio of 3:2. Right? They decided to admit C into partnership for 1/5 share of profits. Okay, so C is the new partner and he is going to come in the firm for 1/5 share. Right? Okay. Which he acquires equally from A and B. So this statement is very important. He got this 1/5 share from A and B, and he got this share equally from A and B. It means what is the sacrifice ratio? In which ratio A and B has sacrificed? In equal ratio. So this is the sacrifice ratio. 1:1 is the sacrifice ratio. Right? And this has a huge impact. So again, let me repeat. When C is the new partner, and he is going to join the firm for 1/5 share in profits and losses, and he got this share from A and B in equal ratio, right? Okay, let's see further. Goodwill is valued at rupees 30,000. So this is the value of goodwill, 30,000, and the partner C is supposed to bring his share, and his share is 1/5, right? And let's see what is his share in this valued goodwill. So he is supposed to bring rupees 60,000. He is supposed to bring rupees 6,000, right? Okay. Now see further. C brings in rupees 16,000 as his capital, but is not in a position to bring any amount for goodwill. So this is the valued goodwill. C's share is rupees 6,000, but he is not able to bring this 6,000 in cash, right? So this is the situation. And what is the requirement? Record the necessary journal entries. So let's see the journal entry. So first entry we will pass for this is 16,000, which C brought as his capital. So entry will be cash account debit, and we will credit C's capital account to C's capital account. How much money? Rupees 16,000. Okay, for now I am ignoring the narration. Narration will be capital brought in by the new partner C. Okay, now see the second entry. Second entry will pass for the goodwill, right? So firm's goodwill is 30,000 and C's share in that is 30,000 is rupees 6,000, which he is supposed to bring, but he is not able to bring that money, right? So don't you think that C is one kind of receivable? He is supposed to bring this money. He is supposed to give this money to the firm, but he is not giving that money, right? So he is kind of a trade receivable, kind of a debtors. Okay, so it means C owes 6,000 to the firm, but he is not paying. So what firm will do? Firm will treat him like a trade receivable, like a debtor, credit customer, I mean to say. So what we will do? We will debit his current account. If he brings the money, we will debit the cash account, but he is not able to bring this 6,000. So what we will do? We will debit his current account. See his current account debit with rupees 6,000, right? So this shows that C is now kind of trade receivable for the firm. So we debited C's current account, and we will credit the sacrificing partner, because C got this 1/5 share from A and B in equal proportion. So we will credit this 6,000. We will give credit to A and B in equal proportion, right? So to A's capital account. A's capital account. How much money? 3,000. Because they both A and B sacrificed for C in equal proportion. So this 6,000 will be divided between A and be in equal ratio. Now to B's capital account. To B's capital account. Same amount, 3000. Right? So this entry will be always in the ratio of sacrifice. And now question comes that why we have credited A and B's capital account. In my previous video also I have discussed this. So again I am going to explain you that why we give credit to the sacrificing partner. The reason why, because this goodwill means this is the extra profit which firm is going to earn in future. Not now, in future. But to generate this goodwill, who worked hard? A and B worked hard, right? So logically this 30,000 we need to distribute between A and B only. C should not get any share. The new partner, Mr. C, he should not get any share, right? But actually what will happen in real life? Because this now firm, Mr. C has joined the firm, and this 30,000 firm will earn in future. So definitely C will also participate in this 30,000, right? How much he will be getting? 6,000, for which he is not eligible actually. Logically he is not eligible with, for this 6,000, but he will be getting unnecessary. So he will be getting unnecessary in future, right? So when he will get 6,000, definitely A and B will get less amount in future. So just to compensate that loss, what we will do? We will increase their capital right away at the time of admission of the partner C. Okay, I hope you guys understood the logic that why we give credit to the sacrificing partner.